What's going on, traders? Understanding the trends and market structure is so important before we can get into advanced market structure. The market is not only about the entries, but by understanding the market structure will help you a lot to avoid some of the false entries that the market may try to throw at you. On our today's video, we are going to be talking about the basic market structure.
Welcome to RFT Airlines.
Firstly, we need to understand the end of the run or the start of the run, because there is no market that moves in one direction forever. So there's the end and the start of the bullish or bearish. Right here, we've got the market that was creating a series of lower lows, dropping all the way to the downside. And then after that, we saw the market creating two equal lows right here. Sometimes it won't be two equal lows. Sometimes the first swing will be a bit shorter than the second swing. But the part that is so important, it is what happens when the market gets around the neckline. It breaks and closes above it. And then after that, a new trend or a new run has started. That is how you can determine if the run has ended, and then how to identify or determine if a new trend has started right there. Now, this run or the first swing right here, I prefer it to be on the previous day. And then the second run and then the second swing have to be on the current day. I don't want to see two swings on the current day and then from there determining the change. No. It have to be on the previous day and then the other one on the current day. That is how I want to see it happening. That's the first thing that will happen. Secondly, the bullish run. Now, in the middle of the run, how to identify the run that has already started? You know that this run has started and it is moving in this direction. You are going to see the market creating a series of higher highs. What it means the market will create a high, meaning a swing high. It breaks it, it creates another high, it breaks it, creates another high, it breaks it. So there you can see that the market is moving to the upside. You are going to see the market keep on creating this series of higher highs there. Once you have that, you can tell that market is moving to the upside right there, up until we get to a scenario where the market reaches a point where the market fails to run. As I mentioned, two ways or two things that you are going to see that the run has ended and then the market is about to begin a new run right there. Firstly, we said you're going to see the market creating some kind of a price ceiling right here, a point where the market will create some kind of two equal highs right there, because right now the market comes from the downside all the way to the upside. So that means now you're going to see some kind of a swing high, and then the market trying to revisit that high right here, fails to break it many times. It could be even one time or two times or many times right there. It just like in this way, what it did, it created a swing, revisit it, and then try to break below, revisits again, and then right after that it started to break and keep on going to the downside right there. And even the way it drops right here, it drops with the way we said the run should happen. Now when you are in the bearish, determining the bearish run, you're going to see the market keep on creating this series of lower lows, swing lows. It creates a low, it breaks it, creates a low, it breaks it. That is how you are going to see or determine that the run has started to the downside right there. Now let's apply everything that we started from the PDF and unpack it right here on the NAS 100 real price chart. The time frame that I like to use to identify the market structure, it is the 4 hours time frame and the 15-minute time frame. 4 hours time frame, identify the market structure. 15-minute time frame, I can apply any trading model, entry model that I like to use. So something you can apply any entry model that you can use, but in line with the 4 hours time frame market structure. Let's get into it and show you exactly what I mean. I'm specifying the 4 hours time frame because this ideology or this thing of the market structure is fertile. It can be used in any time frame that you want to use it. But for me, 4 hours time frame. So on this day, when we approach it, what you have to do first, as the day starts, you've got to identify the market structure, where you are in the market, so that when the day starts, you know exactly where you are going. Now on the 4 hours time frame, we are here, up here. Now what we need to find here, it is exactly where we are in the run? Are we in the middle of the run, or are we about to end the run, meaning we're about to change the run, the trend and all that? So where we are, when we move from where we are on the current day back down, is we've got two equal lows right here. That changed the whole idea of the bearish run and entered the bullish run. And when we check, we don't have any signs of the end of the bullish run. Everything right here still in line with the motion of the bullish right here. So that means on this day we are looking for a buy as per market structure right here. So that means when you scale down to the smaller time frame of 15-minute time frame, we're still going to be looking for a buy, because the forward time frame market structure is telling us that we are going for a buy, since the market is creating the series of higher highs. Let's get back to the 15-minute time frame. Now here on the 15-minute time frame, I'm not going to complicate things. I'm simply just going to use the idea of the market structure on the 15-minute time frame now as an entry model, or as an entry trading model, so that you can see how easy it is to trade in the market. Let's see. But firstly, I need to identify, or I need to mark, when am I going to enter into the market. As you know, the NAS 100 starts to be active and decisive right after 15:30. So therefore I need to mark 15 as usual, so that you can start to look for entries on the other side, not here. Even if I'm using the idea of the market structure, still I have to follow the liquidity or the volume of the NAS 100 as a trading model. Now the market has gotten around here, around where I want to enter into the market from. Here we've got 15. Around 15:30 is when I'm looking for an entry. But let's start here. What we have is the market that opened peak, the high, and kept on creating the series of higher highs. Now I want to see the market retracing a bit back down around these swings, where I want to see the market rising from all the way to the upside. Now let's see. As you can see, now the market has gotten back around these swings. These are the swings that I'm going to use them as an entry reason. Now let us construct a trade that when 15:30 opens, I want to see the market open and go higher. Okay, the idea is to use 1:2 risk-reward ratio, but my chart here doesn't allow me to continue and expand this thing. So that means the take profit should be a bit way higher than that. Now let's see. Voila. As you can see, the market continued all the way to the upside by just looking at this simple entry model right here in line with the higher time frame market structure. Let's look at another example right here. Now in the following day, we are still going to do the same thing. When the day started, all we need to do first is to check exactly where we are in the market in terms of the market structure. We'll check all of that on the forward time frame. Let's see. We are up here, and then what you need to check, it is where we are in terms of the direction of the market. Now when you look back, we still have these two equal lows that fueled an upward movement right here, and along the run we haven't found any signs of the end of the run to the upside. But the only thing that you are seeing, it is an upward movement being more aggressive all the way to the upside. So we can't go against this run right here. So now let's see what's going to happen. So the conclusion on the forward time frame is that the market kept on creating this series of higher highs. So that means we continue with the bullish market. Now here on the 15-minute time frame, now I'm not gonna use the ideology of the market structure in the smaller time frame, but instead I'm going to use the AMD, ICT AMD, the accumulation, manipulation, and distribution, just to show you exactly that all entry models works in the market. It's just that you have to apply them in a good market condition or in a good market structure. Still, before we can do anything else, let's forward this thing to around where we want to enter from, around 15:30 New York Open, because this is the NAS 100. You don't enter at any time or anywhere. You simply enter into the market when the market, when the New York Stock Exchange is opened. That's where these instruments NQ and USD, BTCUSD, they start to be active and decisive in terms of the movements that it produces from there. Let's see. Right now the market has gotten exactly where we want it to be at around 1530, or at around 15, where we are going to see the New York open right here at 1530. Now we've got the market did this, but the market gave us the accumulation right here, and then after that it went all the way down, manipulated right here. Now we want to see the market distribute all the way to the upside right here. So how are we going to enter into the market right here? Here we've got the market that is dropping, and then it created some kind of a swing right here that it broke above. So now I want to see the market open and play around this thing, and then after that I want to see the market rises all the way to the upside. This is for those guys who trade the AMD. Now to construct a trade right here, we are going to put it here, and then the stop loss few pips below this swing, and then after that you can aim your 1:2 risk reward ratio there as your first TP. As you know, I'm all about the risk management. 1:2 risk reward ratio is done. The market can still go all the way up right here, but the risk reward ratio always have to be at 1:2 risk reward ratio as a first TP. Now let's see how this thing is going to play out. Right here I've got accumulation, manipulation, then we want to see the market distribute right here. Let's play. As you can see right there, now the market opened and then it gone all the way back down right here around where we want to enter from. It tapped in and then the market went all the way up. They didn't hesitate to go all the way up. As you can see how easy it was to trade right here. Accumulation, manipulation, then distribution. That's ICT AMD. You know, that means I'm trying to show you exactly that you can apply any entry model in the idea of the market structure. As long as you know exactly what you're doing, you're good to go. Let's move on to another example right here to see what we have. Now with this example, I'm going to show you exactly how important it is to always make sure that you understood where you are in terms of the market structure. Here, let's say you didn't check the market structure, and then what you found is the accumulation. Let's say that you trade the AMD. You've got the accumulation, manipulation right here, and then you've got that swing or that entry model that you found on the previous example, and then the market broke above there, and the timing element is good now. 1530 is coming right here, and then you want to enter as a buy right here. Whenever the market retraces back around here, your stop loss few pips below there, and then your 1:2 risk reward ratio is placed right here as a first TP. Now let us look at it and see what is going to happen if you didn't know or you didn't understood the market structure. Same time in the market, what it did, it opened and took you out without even you enjoying any profit from there. And then even if it continues, the market still take you out. What was the reason for this? Let us check the market structure and see how we're going to approach this day with the idea of the market structure. Let's see. Now, when we have to approach this, we need to start from the 4 hours time frame to check and look at what we have on the 4 hours time frame, where we are in terms of the market structure. Now, we are here on the 4 hours time frame. When we have to check, this is exactly where we are. This is the day where we are going to take some trade from. Now, when we look back, you can kind of see that the market went up, created this swing right here like this, and then what it did, it broke below the neckline. Remember what you said when the market broke below the neckline, and I even mentioned that the market sometimes it will create some swings that looks like this. Now on the 4 hours time frame here, we need to check exactly where we are in the market. Right here we've got the market. When you look back, you can see that the market comes from this type of pattern that we said the market will paint to show you the end of the run. Right here it was going up, and then it painted this pattern right here up here to show you the end of the bullish market. It broke below and closed below. Then after that, it dropped all the way to the downside, even though it tried to move aggressive, but couldn't break above all of these swings that you found right here that showed the bearish market. Then after that, it continued all the way to the downside. So with this, that means we are still looking for a bearish market because of all of these swings that the market has been creating, all these swing lows. So therefore, at the right time here, we still want to continue to the same direction. Then on the smaller time frame of 15-minute time frame, everything now is easy. You can see exactly where you are, where we are going in terms of the direction. Put this thing to know exactly when the time is right. So right here, what exactly are we looking for? We are looking for the market to open and go a bit higher to any of these swings right here. So where we are going right here, we know the direction of the market. Want to see the market open, rise, and drop all the way to the downside. Now let's use this idea of the market structure right here. So what we want exactly right here is the market to open, rises around this high. That is where we are going to enter our first trade from. Now let's allow the market to play. Right, as you can see, now the market has gotten to this area. Now it's easy for us to start to drop with the market. You can simply enter on the line right here or enter exactly where it is. So for the sake of this video, let's say we're going to enter right here. Then the stop loss is going to be a few pips above this swing right here. And then our first take profit was going to be at 1:2 risk rate ratio. Okay, since my chart doesn't allow me, we will keep on extending this TP right here. Let's play and see what you have. As you can see, the market kept on dropping all the way to the downside in line with our take profits. As you can see, our first TP right here at 1:2 risk rate ratio was achieved, and the market kept on dropping all the way to the downside because that is all in line with the market structure. So the market structure is very, very, very important, and you can apply any type of entry models in the market structure right there. Let's see. Let's move on to another scenario, to another example right there. On our last example here, let us go to the Forex time frame, as you know, to check exactly where we're coming from. On the Forex time frame, we're still running through that swings that fueled a downward movement that the market broke below and then now dropped all the way to the downside right here, as you can see. So that means the market kept on creating this series of swing lows right there. Then now we're still into continuing to the same direction with these swings that the market kept on creating to the downside right here. So there isn't much to explain right here. You now know exactly how to look at it, how to approach the market. Right, now with this one right here, we now know that on this day we want to continue to the same direction. Then on the 15-minute time frame, now I can simply just throw the RFT Trading Model as the last example in this case, in line with the market structure. Right here, what you have, we've got 9 and 15. What we have, we've got the market that opened, pick one direction. Therefore, at the right time, we want to see the market open, pick the high, and then drop all the way to the downside, which is exactly what I always show you in my videos right there on how to approach the market with the RFT Trading Model. Now here, open, rise at 15.8, and then it drop to the downside. Now let's see and play. Now everything was easy. Now we can simply jump in right here at 15.80. 15.80, we want to see the market open, and then what it does, drop all the way to the downside. Even though I want to wait for 15.80 first to see how it opened and how it plays, because sometimes the market can simply just open and rise all the way to the upside before it can drop. So now let's construct a trade somewhere here on how to enter into this market right here. Now we're going to take this thing and then we put it somewhere there, a few pips above there, the stop loss, and then 1:2 risk rate ratio, as you know. But for now, this thing doesn't allow me. We will keep on extending this TP. Right, Okay, let's see. The market is still pushing all the way to the downside. As you can see there, 1:2 risk reward ratio was achieved. Oh, it has not yet. Let's see. Okay, with all of that, as we can see, 1:2 risk reward ratio has been achieved, and the market still continued to the downside. That is how you will be looking at the market from now on, using the market structure. That is a well-defined video of the market structure you will ever find here.